Investing used to be an exercise in careful analysis. Lately, it feels closer to watching a game of roulette. Someone on Reddit turns a weekly options trade into a 2,000% gain, post a screenshot, and suddenly it looks like they've found a speed run for the entire financial system. Then you look at the professionals. Take Michael Burry. He famously made $800 million betting against the housing market in 2008, using pure, rigorous math. He is the human embodiment of trusting the data and ignoring the noise. And recently, he completely shut down his hedge fund. In his own words, his estimation of value in securities is no longer in sync with the market. He essentially admitted that the market has completely stopped pricing assets based on underlying financial data. You see this exact behavior playing out everywhere. From gold to real estate to equities and crypto, assets are surging violently with zero correlation to any traditional anchor. If the most proven, data-obsessed investors in the world can no longer read the compass, we have to find out exactly what invisible force has taken over the steering wheel. For most of modern financial history, markets were anchored to reality. Earnings, cash flows, and economic data governed the system. Markets have always had manic phases, from the large-cap stocks in the 70s to the dot-com bubble in the early 2000s. But eventually, intrinsic valuations acted like financial gravity. The underlying math always pulled those speculative bubbles back down to earth. The 2020 pandemic completely rewired that baseline. The old strategy of buying quality companies at fair prices for the long term dissolved. It was replaced by a universal assumption that every dip is a gift, and stocks strictly go up. This shift didn't happen in a vacuum. A massive influx of new retail investors collided with historically low interest rates and Jerome Powell running the Federal Reserve's money printer like a fire hose. Markets have been expensive before. The real break in the system is that the link between a company's actual performance and its stock price is severed. When the market stops behaving the way professionals were trained to understand it, decades of experience suddenly becomes a liability. This brings us to behavioral finance. Traditional finance assumes the market is an efficient, rational calculator. Behavioral finance assumes the market is human, driven entirely by fear, greed, and herd mentality. Back in the late 1970s, psychologists Daniel Kahneman and Amos Tversky proved this. They showed that humans do not evaluate risk objectively. We fear losses heavily, we anchor to stories, and we blindly follow crowds. Despite that evidence, Wall Street spent decades keeping these concepts on the fringes. Traditional investors used human psychology as a convenient excuse to explain away the occasional panic or rare bubble, not as the rule. But sometime after 2020, that hierarchy flipped entirely. Human psychology stopped being used to explain the weird edge cases and became the primary logic that everyday asset pricing runs on. Investors are no longer asking about a company's intrinsic value. The only question that dictates price action now is how the crowd will react to the current narrative. These psychological forces have always existed, kept in check by a slow system. The catalyst that weaponized those emotions was the total removal of friction. In the past, information spread over months, and participating in the market took time. Today, you can read a viral narrative online and deploy capital instantly, all before you've even finished brushing your teeth. This chart shows how institutional money is adapting. Huge funds are abandoning traditional cash flow models, instead scraping online forums to run sentiment analysis. Right now, these raw emotional variables dictate short-term price action far better than actual financial data. The internet completely erased the physical distance between an emotional reaction and a financial transaction. When enough people agree on a story online, the narrative violently overpowers the numbers. We are sitting at a historical crossroads. There are two completely different, equally valid conclusions about what happens to the market next. The first possibility is that we are simply living through a massive, tech-fueled bubble. History shows us that eventually the old gravity of fundamental valuations will return and wipe out the speculators. The second possibility is that the mass influx of retail money and zero-friction trading has changed the basic mechanics of the global market for good. If that second scenario is true, we have entered a completely new regime. The stock market no longer prices cash flows. It operates purely as an attention pricing machine. I want to know where you land on this. Are we watching a familiar emotional bubble play out, or have we witnessed a permanent evolution in how markets operate? Let me know down in the comments. There might be a final irony to all of this. Sitting back and debating whether the market is acting rationally or emotionally is in itself a symptom of the exact same psychology that is driving the chaos.